Welcome back to the Macro Gamer channel. My name is Mark Hassingham, and today we're going to be going over the investment portfolio strategy we're going to be showcasing on this channel. So, I've created a slide deck going over some of the topics, my inspirations, kind of the reason why I got here. We're going to go over the type of investments, what I'm using in the portfolio, and how we're going to go about it going forward. So, follow along with me, and I'll go ahead and I'll go through this slide deck. So, the title is Investment Portfolio: How to Create a Diversified Investment Portfolio to Protect Your Assets and Build Wealth Slowly. And I say build wealth slowly because this isn't get rich quick. This is making an investment strategy, a diversification strategy. You're not going to get massive growth or a massive loss, ideally. You're just going to have slow, steady growth. And we're going to do our best to avoid crashes or recessions or corrections in the stock market by allocating our allocating our assets to the correct asset class. So the difference between stocks, bonds, commodities, gold, currencies, and Bitcoin. We'll be moving money in between these different assets. So let's go over some of the inspirations kind of how I got here. So the way I look at it, there are three pillars of this investment portfolio. Over the years, kind of what I've learned. I've been investing since 2014, so there's a lot I've learned, but there's kind of three big things that kind of stuck with me and kind of shaped my thesis on investing and how I created this portfolio. So there are three individuals who have contributed to the inspiration, foundation, and discipline of the creation of this portfolio. The first one, way back in, I think about 2014, 2015, can't remember exactly when, Tony Robbins' book, Money Master the Game, was a big inspiration for me. There are several people he interviews in that book about, how they became wealthy. And at the end of each kind of interview, he would ask them a question about, what do you think about, or how would you create a portfolio without everything you have now? Like, how would you create from scratch? You want to pass it on to somebody else. That was kind of his idea. One of those people he interviewed was Ray Dalio and his all-weather portfolio, which is kind of the foundation of how I got this idea. And he talked about how he would build a diversified portfolio of assets. And the third is Keith McCullough's Hedgeye platform. It's kind of the discipline. So it's a daily show that they have on their platform that they go over a lot of the fundamentals of growth and inflation, diversification, risk management, things like that. So it's kind of how I involve active management with this portfolio. So for first pillar, Tony Robbins' Money Master the Game. When I was in my early years of starting to invest in 2015, I came across Tony's book, and it better helped me understand what individuals did to create wealth. So as I said, there were several people in that book that he interviewed. I can't remember all of them. The standout, though, was Ray Dalio. So this was the first time I heard about Ray Dalio, the actual first time I heard about him and his all-weather portfolio. To me, it kind of just was like a light bulb going off. It made a lot of sense. I really liked what he had to say. And all the other people in the book, their answers to Tony's questions of, how would you build wealth? It didn't make a lot of sense to me, but his did. Prior to this interview, Ray did not divulge his investment portfolio and how he created it. And even in the book, he doesn't give the exact, this is how it's all done, but he gave a pretty good example of diversifying between, I believe, 5 different investments. One was stocks, one was long-term bonds, one was short-term bonds, one was commodities, and one was gold. If I remember the exact percentages, stocks was 30% of his portfolio, long-term bonds was 40% of the portfolio, intermediate bonds was 15% of the portfolio, and then commodities and gold were each at 7.5% of the portfolio to make a 100% allocation. As I said, this was my light bulb moment that started my interest in this portfolio. Pretty much after seeing that and how Tony Robbins compared specifically the drawdown, where you could have average returns, as average as in meeting like S&P 500, like the index, like average returns compared to the market, but not have the drawdowns that the S&P 500 has. Like in 2000, there's a dot-com bubble. 2008 was the GFC, Great Financial Crisis. 2020 was COVID, big drop down, things like that, where there's these sharp drops in the market. So to help protect yourself and all that. Ray Dalio's all-weather portfolio. So prior to hearing about Ray Dalio and his portfolio, I had no idea how to even create a portfolio. I barely knew how to pick stocks, and that's very true. This was the beginning years, like I said, 2014, 2015. I was just starting out. Mostly I watched just financial television, like financial entertainment television. And it was just people bringing up the news every day. It wasn't like a consistent strategy. It was just like what was like topical, like what was the most interesting thing that was happening that day. So reading this book and finding out about it was very helpful. So as I just said, he outlined a simple version of a strategy in the book: 30% equities, 40% long bonds, 15% intermediate bonds, 7.5 gold, 7.5 commodities. This portfolio got an average return close to the historical return of the S&P 500, but with less downside risk. And again, the point of this, moreover, is diversification and protecting risk. It's not get rich quick, it's build wealth slowly, as I said in the beginning. So this is like, think of like a 401k or a pension, something very long-term, an IRA, that you're not going to withdraw daily, you're not going to draw with weekly or monthly, you're building it over months and years, decades even. You're going to rely on this in your old age one day. You're going to be able to draw on it. It's going to help you retire. From this point on, I set out to create my own all-weather portfolio. And back then I did. I just basically copied what he did, the 30%, 40%, 15, 7.5, 7.5. And I watched it, I learned from it. But later on I realized, as good as it is, and it wasn't bad, I wanted to do something more active, and that's kind of where the next step comes, or the next pillar of the process comes in. So the next one is Keith McCullough and his platform Hedgeye, or his research firm Hedgeye. Along the way of trying to create my own all-weather portfolio, I came across Hedgeye Research Firm. This platform taught me the discipline to not only pick the assets I need for my strategy, but also how to manage the portfolio. So they put out research daily, Monday through Friday. They put out numbers for their investments. I can't say everything because it's proprietary, but I subscribe to it, so I get the numbers. But every day, every week, I'm getting these numbers. I'm evaluating the data, I'm evaluating the charts, I'm evaluating the fundamentals, and I'm making an investment decision based on all that. So Hedgeye is a really good augmentation to my investment process. Over the years, I've learned how to trade and manage my risk in this portfolio to have positive growth and protect from losses. One example, when I started, I think in 2018 or 2019, 2018-19, when I was really trying to get this portfolio going, I found out, I think about Hedgeye in late 2019, early 2020, right before the big drop from the pandemic. And at the time, they were, I don't remember specifically what they're advocating for, but it was more like bonds and gold and dollars, where everyone else was just bullish on the stock market. And when we had that turnaround where the stock market dropped, my portfolio took a little hit, because everybody was taking a huge hit during that time. But comparatively, the stock market dropped a lot, like more than double-digit percents, where I only dropped like single-digit percents. So I was able to like risk manage that. I was able to save myself from that drawdown. And then when the stock market started turning, I kind of moved more back into equities and stocks, and I was able to stay ahead of the stock market a little bit. Now, because I'm diversified, the stock market eventually kind of surpassed and went past me, because it really just was a blowout year. Because even though 2020 dropped hard, it recovered really fast. It had like if you look out on a chart, it's like a V shape, where the chart came down and then very sharply hit a bottom and then started going back up. So it eventually got to the point where it kind of came back up where my growth was, but that's fine because I'm going for the average return. But I didn't have that big drawdown, which really saved me. So overall, portfolio strategy. Kind of the things I'm looking for basically as I'm making decisions. So following rate of change of growth and inflation. Two common metrics that people follow: the growth of the economy and the inflation. Right now in 2024, inflation came down off of a 9% down to about, I think, 3%. But it's 3% like every month. It's like it's coming out, it's still consistent, so it's still kind of high. But following those numbers kind of gives you a good gauge of which investments we're going to be using. Follow trend duration of individual assets in portfolio. So trend duration, and I'll show you that on charts, can just look at any asset. Let's take the S&P 500 for stocks and look at it on different time frames. So 1 month duration, a 3 month duration, a 6 month duration, a 1 year duration, a 5 year duration. You're just looking at the duration of the asset class, and you're making investment decisions based on what you see. Utilize 6 different asset classes. So first one's going to be stocks, and these are all going to be ETFs. So a stock ETF, a bond ETF, a commodities ETF, a gold ETF, a US dollar ETF, and a Bitcoin ETF. Dollar cost averaging. So we're going to basically deposit $10 every week. It's just going to be automated, and that $10 will be spread across those 6 assets based on the percentage that I set up for the portfolio. So as an example, I have gold at like around 30% of the portfolio, and you'll see that. So out of a $10 investment per week, $3 is going to go towards the gold ETF. And it's every week, $3. Now, if I change the gold percentage from 30% to, let's say, 20%, the next following auto deposit, instead of doing $3 into gold, it's going to do $2 into gold. And I'll show those, from week to week to week as that happens. Allocate a certain percentage of capital to each asset class. So the idea is no asset class is 100% of the portfolio, and no asset class is 0. Typically what I've been doing for the past few years is no asset class, whether it's gold, stocks, bonds, whatever, will exceed 30% of the portfolio, almost a third of the portfolio. No asset class will go beyond that. Diversification means you got to put that money into other assets. Even if you don't think they're going to perform the best, it's a risk hedge. So in case something goes bad with this, something like, let's say I have that gold at 30%, which is my highest right now. Let's say it crashes, but stocks go up. I only have 10% right now in stocks, but of that 10%, that'll go up and that 30% will go down. So I'll take a hit here, but I can recover some of that loss in the stocks going up. It won't be as much because it's 30% versus 10%, but the point is I won't lose as much as 30, but I won't unfortunately gain as much on that 10. We're just making sure we're diversified. We're trying to balance it out. We're not trying to have big drawdowns like in the GFC or .com bust where it's double-digit percentages. Volatility adjusts the weighting of each asset class. So, as I said, roughly between 30%, or I should say around 30% is the height. The lowest would be about 5%. There should never be 0. You always got to have your money invested in one of these assets. The lowest I have right now is Bitcoin at 5%, just because, as the point is, volatility. There's no asset in this portfolio with greater volatility than Bitcoin. So I put it at a lower percentage, because if I put a higher percentage and it just drops, that's a big portion of my money just tanking. Vice versa, obviously, people will say that if it goes up, then a big portion of our portfolio will go up, but we're more concerned about the downside, the volatility. So we're going to have that at a lower percentage. Now, I could theoretically put it at that higher end of the threshold at 30%, but for me, that's a lot of volatility for a large percentage of my capital. So I may not go that high with Bitcoin. Maybe 20% as an example might be the max. Maybe 15%. It just depends. I got to be really like optimistic about Bitcoin for me to put a higher percentage. So back to those data statistics, growth and inflation. So we're going to use rate of change, ROC, data of acceleration for deceleration. So inflation every month and GDP every 3 months. They'll put out numbers. So we're going to follow those numbers, and we're going to kind of see how they affect our investment. GDP growth, that's just as the economy grows, we're going to see that number. Is the economy going up, or is the economy shrinking, going down? Inflation, same thing. Is inflation going up, or is it deflation, going down? We're going to use the year-over-year data for duration. So growth year-over-year and inflation year-over-year. You can also follow these, I believe, like monthly and quarterly, but we're looking specifically for year-over-year. So if we're in July and we're looking at inflation for July, we're going to compare it to July of 2023 because we're in July 2024. And we're going to compare the inflation rate. Is it up or down compared to previous year? Same thing with growth. We're going to look at July's growth from 2023, compare it to July's growth of 2024, and is it going to be growth? Is it going to be growth or decline? We're going to measure that. We're going to look at that. We're going to increase percentage weight of assets relative to accelerating or decelerating data. So if I see, as an example, gold going up, I would want to increase that. But like I said, right now we're at our max of 30%. But if I see gold going down, we're going to want to decrease the percentage to gold because we don't want to lose more money. We're still going to have a position in gold because we're diversified, but we're going to either increase or reduce the percentage of capital to that investment. And then we have our growth accelerating assets. So if we're seeing growth in the economy going up, accelerating, we're more interested, doesn't mean guaranteed, but we're more interested in equities, crypto, and commodities. If we see growth decelerating, so growth is going down, we're going to be interested in bonds, currency, and gold. If we see inflation accelerating, we're going to look for commodities, gold, and equities. And if we see inflation decelerating, we're going to want equities, crypto, and bonds. Now, this isn't perfect. This isn't going to play out like this every single time, but this is just kind of a thought process. Like whenever we see growth and inflation accelerating or decelerating, we're going to think about repositioning our assets in our portfolio. We're going to either increase or decrease the percentages to these 6 different ETFs. Trend duration. So I said this earlier. Follow short-term duration, 1 to 3 months. That's typically what I'm going to be looking at. That's kind of my personal trend duration. When I dollar cost average every week, it does not mean I am changing the percentages of these investments every week. For the most part, they'll stay static for weeks, maybe even like a month or two before I make a change in the portfolio. But we look at that 1 to 3 month time frame. Use midterm duration, 6 to 12 months. So this is what I'm looking for future trends. So I'll look on a 6-month chart or a 1-year chart, 12-month chart, and I'll kind of see the overall trend where it's going, and I will kind of, in my own mind, kind of predict out what I think the asset's going to do, whether it's going to go up or down. And then use long-term duration, 1 year plus, for historical data. So usually when I look at a chart, if it's for the first time, the first thing I do is I look at the as far back as I can go. If it goes back 20 years, I want to see 20 years of data. If it goes back 100 years, I want to see 100 years of data. I want to see the chart completely, and then I want to zoom in over the durations. So let's say a 10-year chart we'll start with, and then I'll zoom into a 5-year chart, and then I'll zoom into a 1-year chart, I'll zoom into a 6-month, a 3-month, 1 month, and 1 day. Because I want to see the whole picture, and I kind of work my way down from there. I don't want to start in the tick by tick, minute by minute. This is long-term investing, like I said, like a 401k, an IRA, pension. You're thinking years and decades into the future. Okay, so diversification of assets. So these are going to be the 6 individual assets in the portfolio. Equities or stocks is going to be represented by ticker symbol RSP. This is an equal weight S&P 500 index. The typical index you see is the SPY ETF, but it is not equal weight. It's more heavily weighted in like the top 7 stocks, like Apple, Nvidia, I think Amazon. There's like a few others. I don't remember all of them. But we want an equal weight. We don't want to be overweight in something. The whole point of this is diversification. Commodities, which is the USCI ticker symbol, so the United States Commodity Index. This covers several commodities, actually over a dozen, and they invest in each commodity based on the performance. Bonds, ticker symbol GOVT. This invests in all durations, so I believe 1 through 30 year durations, so 1 year, 2 year, 3 year, 4 year, 5, and it has an average duration of I think like 8 years or 9 years. So it's pretty close to like you could say like a 10-year bond in terms of performance. But again, we want to diversify amongst the durations to kind of give an average percent. Gold, which will be ticker symbol GLD ETF, that just follows the spot price of gold. So if gold's up today, that gold ETF will be up today. If gold's down today, that gold ETF will be down today. Currency, following ticker symbol UUP. This follows the US dollar. The UUP follows the DXY index, or Dixie index, people have called it. It's just following the performance of the US dollar. The dollar's great to have in your portfolio when like shit hits the fan, basically. So if the market's crashing, or there's a big sell-off or something like that, people may flee into like US dollars just because they want to hold cash, because they're not certain on the market. And the last one is our crypto investment, which is BITO, BITO ticker symbol, which is following Bitcoin's performance. So whatever Bitcoin does that day goes up, it's going to go up, or it goes down, it goes down. The correlations to each of these things are never perfect. They're just ETFs that follow certain indexes or asset prices. Just keep that in mind. The dollar cost averaging part. So we're going to set up a recurring deposits, as we talked about. We're going to choose a duration that matches your pay period. Now for me, my pay period's weekly, so I'm going to do a weekly $10 a week. If you're following along doing this and you think maybe this is interesting to you, you don't have to do what I do. But the whole point is, like, whatever your paycheck period is, like I keep saying, like a 401k or a pension, the company that you work for automatically takes the money out for you and invests it. So they're dollar cost averaging for you. We're setting up our account to do this for ourselves. So this is all on our own. Choose amount of money that you won't miss if lost. I put in parentheses lunch money. What I mean by that is, start small. Don't go, I'm going to invest my entire paycheck into this. Don't go thinking, you're going to get rich quick. Remember, it's build wealth slowly. So when I say lunch money, it could be like $5 or $10, maybe more, $20. I don't know. It depends on you. But for me, like $10 is fine. Like that's an amount of money where if I was walking down the street and I had a $10 bill and it fell out of my pocket, and I got home and I reached in my pocket to grab that $10 and it was gone, I wouldn't be devastated over that $10. I wouldn't be happy that I lost it, but I wouldn't be devastated that I lost $10. It'd be different if it was like $1,000, $5,000, $10,000. Then I'm gonna be like, what the fuck, right? But $10, if I lose that in the market, hypothetically, I'm not gonna be happy, but I'm not gonna be devastated by that. If I lose my entire net worth, overnight, whatever it may be, then I'm gonna lose it, of course. And then set the duration of automatic deposits to non-stop. So basically every week, we want this to keep going. We don't want to pick when we invest, in the sense that this week I chose Monday, next week I chose Tuesday, next week I chose Monday again, following week I chose Friday. Like, we just want to pick one day, set it up automatically, and forget it. Once we put that $10 in every week, let's say I choose Wednesday of every week on Wednesday, $10 comes out of my wallet, or out of my bank account and into the investment account. I don't have to think about it. It just does it automatically. Right, like I said, same thing with 401k or pension fund. It just happens automatically. Allocation. So I kind of talked about this earlier. So set a percentage of capital to each asset class. No asset class shall exceed 30% of capital. No asset class shall subsede 5% of capital. Percentages will change as the trends change of each asset class. So as I said, as I'm watching these asset classes go up and down, if I see stocks really going up, I'm looking at growth, I'm looking at inflation, I'm looking at my charts, I'm looking at the, Hedgeye's numbers that they give out. I'm going to make a decision. I want to increase, my 10%, let's say, position of stocks to 15%, because I want to get more money out of that. Percentages will be greater than or less than based on growth and inflation. So as I just said. Volatility adjust assets. So each asset is not treated the same in terms of percent allocated. As I said earlier, Bitcoin's very volatile. I'm not going to put a majority of the money in that, because yes, I can make a lot of money, but I can also lose out a lot of money. Every asset class has a volatility that varies from one another. A high volatility asset like Bitcoin, BITO ticker symbol, may be at a lower percentage of capital due to large swings of movement. A low volatility asset like currency, UUP, which is just US dollars cash, may be a higher percentage of capital due to small swings of movement. So I'm totally okay putting UUP dollars at 30%, because the swings in that price movement isn't going to be that much. So it's more of a safety net anyway. So typically I won't have a lot of money in there. It's just over time, at what point am I going to increase or decrease my money to that? So if it's volatile, if the market's crashing, I'm like, this is a really good time to be in dollars right now, to be in cash, because people are freaking out. and I don't want to, have my portfolio drop, or vice versa. The market's very euphoric, and stocks are on the rise and everything, and I don't want to put my money in dollars because it's just gonna have slow growth. I want something more volatile, maybe like Bitcoin, maybe like stocks. And that's it for this. I hope you all got something good out of this. I'm gonna have more videos out in the future. Again, I'm going to keep explaining this investment process as we go on, week by week. This isn't a one-time thing, so I'm going to explain it as much as I can. You can ask questions. You can critique me. You can say whatever you want. It's fine. The long-term goal, remember, as I said on here, is that last part of that sentence: build wealth slowly. It's not get rich quick. It's build wealth slowly. So keep that in mind as you're following along. And if you're interested at all in investing, there's no time like the present. So see you on the next video, and good luck.